Hi everybody, this is Gary Dean and this is our weekend video report for Sunday, November 8th, 2015. The Bears gave it a go on Friday, but we continue to find just buyers of the dip, and there's still mounting evidence that is looking for a pullback that's going to last more than a couple hours. And if we just look at our internal charts, this is the put-call ratio for equities, and you can see we're still at the lowest levels we've seen all year with the MACD, which means that there's a real lot of call buyers down here, and it's a contrarian indicator as the S&P is right in the middle of some heavy resistance. If we look at the Nemo, this one is, you can see that I've been following this little fractal pattern here where we had the big move down, went sideways and down, and you can see that's right in this time period here. And that was when we saw the big drop in the S&P going back on into last, I think it was December of 2014, where it dropped a little bit over 100 points. The pattern is very, very similar here. You can see we had the bump up and down where the MACD is below the zero line. And if it's going to follow this pattern, we would see a pretty quick 100 to 130 point drop. So that's another piece that is standing out. And if we just take a look at the put call ratio for the total, what I have here is you can see the MACD has shot up here, and what this blue line is, because this is pretty much right where it is right now. So this represents all the different times that it was here, these red lines, and it shot above. And if you just look at what's taken place with the S&P, we had a drop here, we had a drop here, we had a drop here, and then we had a big drop. So these are the different times when we've, broke above here, and that's pretty much what's playing out right now. And we're also coming off of the, some of the lowest levels we've seen in years. So that would suggest that it could magnify the move down when it starts. But that's pretty much, the important piece is all of this information. They're just warning signs. And until we see price actually react to the downside, they're just warning signs. So it would be, be very cautious if you're long, expect the drop. But until we see these dip buyers, step aside, this is what's playing out, is we're just getting these quick drops and they're buying it right back up again. So this is your resistance zone that the bears will try to defend. That goes anywhere from the 21.15 up to the 21.34. Your neutral zone, where the bulls would want to defend and what the bears want to get it through, would be anywhere from your 20.58 down to your 20.36. If it breaks that, then we would anticipate that we're going to get the larger drop that would come down to anywhere from the 2000 down to the 1980 area. So this is really the easiest way to look at things on who has to defend where, and your neutral zone. And then this would be, if we ever did get a bigger drop like this would be where I would be interested in buying. I'm just not interested here, not with the internals the way that they're showing right now, where we're very overbought. We have bearish divergences, and we're seeing some internal technical instruments that are really as overbought as we've seen this market in many years. So that's pretty much it on that. Taking a look at the hourly chart, here's the bearish wedge. We broke through it more on just time. And these are your, just the support areas that I've been mentioning, where if the bears were able to push the price below this, we should get down to the next support level, which is 2077. Obviously, they came in a little bit early at the 2083 level. So right now, what the bears would need to do is hold it below the 2102. If they do that, then and they push it back down, obviously we'd be looking at the 2078. But the thing is that only a 23% retracement from this low to this high, which is basically the rally that we've seen, brings us down to the 2058 level. So we're not even close to even just a regular shallow retracement. And what's more likely, because of the wave structure, we would see something come down to the 38 or even the 50% retracement, which brings us to the 2022 and the 1993. So these would be more likely targets. But again, until these dip buyers get away, right now it's it's just business as usual for the bulls. But these would be your normal retracement levels. We obviously have bearish divergences. We're still we came off of the overbought levels on the momentum. And it's just, again, it would make sense for a move to come down here for the bulls to take a little breather and then possibly head up towards into the end of the year. On the 15-minute chart, you can see we did get into the oversold levels. We didn't have bullish divergences. We had them here. But then when we had the big drop on Friday, they didn't form because it was a lower low there. So the support area that the bulls are going to watch, again, is that 2077. I think really what you could look at on a what the bears would want to defend would be that 2102, and then we could even bring this down to here, these previous tops. So the 2102 and the 2109. Obviously, if they get above those, then they're going to be looking at that 2115. So, again, from a technical point and from just the internals, it would make sense for a deeper drop than what we've seen that's going to last more than an hour or two. We just really have to kind of, wait for price to break before expecting the lower numbers, and then we can start determining where that low might be for the next rally that will probably take us into year end. So with that, enjoy the rest of your weekend, and I will talk to you guys tomorrow.